After the dust has settled on the tax season of 2024, a great number of individuals and organizations are scratching their heads in disbelief at the surprisingly low amounts that appear on their returns. There are a lot of questions, such as why the tax refunds this year are smaller. Which elements played a role in the occurrence of this unanticipated result? It is necessary to take a more in-depth look at the many economic, legislative, and individual issues that are at play in order to comprehend the complexities that lie behind the 2024 tax returns. Economic factors. The impact of inflation is one of the key factors that will lead to lower tax returns in 2024. This is because inflationary pressure will be seen throughout a greater number of economic sectors. A decrease in the purchasing power of money is the result of inflation, which has the consequence of lowering the value of both incomes and assets. Consequently, even though individuals may have earned comparable salaries as in past years, the actual worth of those earnings has declined, which has resulted in lower tax liabilities. This is because of the combination of factors. Recovery from economic disruptions. The aftermath of severe economic disruptions, like as the COVID-19 pandemic, frequently results in different phases of recovery that are more complicated. Although there is a possibility that economies may recover, the rate of recovery and the extent of the recovery can vary greatly depending on the industry and the region. It is possible that the lasting impacts of economic recovery efforts had an impact on firms and individuals in the year 2024, causing their taxable incomes to be affected and resulting in decreased tax returns. Legislative factors. Alterations to tax policy. Alterations to tax laws and policies have the potential to have a significant influence on tax returns. There were a number of legislative changes that took place in the years preceding up to the year 2024. These changes included modifications to tax brackets, deductions, and credits. It is possible that these modifications were put into place with the intention of simplifying the tax system or stimulating economic growth. However, they may also have an impact on the bottom line for taxpayers. In certain circumstances, taxpayers may discover that they are subject to higher effective tax rates or fewer chances for tax savings, both of which contribute to poorer returns. Stimulus measures. During times of economic distress, the government's stimulus measures, which included direct payments and tax credits, played an essential role in providing help to both individuals and businesses. It is possible that these actions, despite the fact that they offered much-needed relief, also affected the levels of income that were reported on tax forms. As an illustration, individuals who got unemployment benefits or other forms of help might have had lower taxable incomes, which would have resulted in reduced tax responsibilities and, as a consequence, lower returns. Individual factors. The dynamics of employment, shifts in job status, salary, and hours worked can have a substantial impact on individual tax returns. It is possible that individuals will have encountered changes in employment dynamics in the year 2024 as a result of variables such as the conditions of the job market, the rise of automation, or the development of industry trends. Reduced taxable incomes and, as a result, reduced tax returns can be the result of a number of factors, including the loss of a job, a reduction in salary, or a shift to working part-time. Performance of investments. The performance of investments, such as stocks, bonds, and real estate, can have an impact on the tax returns that investors receive. The determination of taxable income is influenced by a number of factors, including fluctuations in investment markets, shifts in asset prices, and gains or losses that have been realized. During the year 2024, investors might have encountered difficulties that were caused by the volatility of the market, fluctuations in interest rates, or changes in regulatory regimes, which had an effect on the size of their tax returns. Strategies for tax planning. The choices that individuals and organizations make with regard to tax planning and compliance can have an impact on the results of their tax returns. Depending on the circumstances, taxpayers may choose to participate in methods that may help them reduce their tax obligations. These strategies may include maximizing deductions, delaying income, or making use of tax-advantaged accounts. Changes in tax legislation or enforcement methods, on the other hand, might reduce the effectiveness of particular tax planning strategies, which can result in reduced returns for specific taxpayers. Moving forward. It is possible for people and organizations to gain the ability to make informed decisions regarding their financial planning and tax compliance strategies if they have a thorough understanding of the elements that will contribute to lower tax returns in 2024. As the economic climate continues to change and legislative landscapes undergo transformations, it is important to remain current on these developments and seek the advice of professionals in order to minimize risks and maximize tax outcomes. Furthermore, the promotion of openness and accountability in tax policy and administration has the potential to contribute to the creation of a tax system that is more objective and equitable for all parties involved. A convergence of economic, legislative, and individual issues that influence tax returns has been brought to light as a result of the 2024 tax season. A comprehensive study of these elements can provide